This video is the continuation of the first video on Forex currency trading. Here we'll mainly cover the scope of Forex trading in India. The following main areas will be covered here. There are four currency pairs traded in NSE, that is the National Stock Exchange, which are USD-INR, Euro-INR, GBP-INR, Japanese yen-INR. But we'll cover mainly USD-INR as liquidity is present only in this currency pair. The concept of USD index and its composition. The future market and the options market in the USD-INR in India. The margin requirement in USD-INR futures and options. The economic factors and the central bank actions affecting rupee exchange rate. The realized volatility of USD-INR and other currency pairs. The opportunities and risks of trading futures in USD-INR. The factors to be considered for futures trading in different currency pairs. The opportunities and risks of trading in USD-INR options. The broad trading strategies of currency options. I am Aninda Datta, the presenter. A very important index for foreign currency traders is the USD index, as it impacts all the foreign currency transactions, foreign exchange valuations across the globe. So let's study what is USD index and its effect on the USD-INR exchange rate. US dollar index is an index of the value of US dollar against the basket of foreign currencies, often referred to as US trading partners currencies. It is the weighted geometric mean of the dollar value related to the following selected currencies: Euro, Japanese yen, Great Britain pound, Canadian dollar, Swedish krona, and Swedish franc. Now all these are showing the relative composition of individual currency pair in that USD index. As you can see, the weightage of euro is maximum in this entire USD index. Even Canadian dollar, Swedish krona, Swiss franc, these are also having small presence in the USD index. Great Britain pound has the Japanese yen has the second highest weightage, and Great Britain pound has the third highest weightage. Surprisingly, there is no Chinese yuan in the basket, even though China is the largest trading partner of US. That is mainly because yuan lacks the capital account convertibility and is partially controlled by their central bank. The USD index has a small positive correlation with the USD-INR, as the USD-INR rate is largely determined by the rupee related factors and actions of the Indian central bank. Now let's examine the benefits of trading in USD-INR. USD-INR has a historical annualized realized volatility of around just 3 to 4%, which is much lower than that of any other asset class, as the margin requirement for future and option trade depends on the historical realized volatility of the underlying asset. So the margin requirement to execute a specific contract value is the lowest for currency trade among all the asset classes. The margin requirement to buy 1 month futures contract having a lot size of 1000, having a contract value of rupees 83,000, considering an exchange rate at 83, is just around 2,500. The margin requirement for selling one lot of option contracts of USD-INR having 1 month expiry is just around 2,000. However, the margin requirement for incremental short options varies depending on the overall exposure of an account. Similarly, the margin requirements of future contracts and other currency pairs are also similar, that is on the lower side, as those also have low realized volatility. Therefore, trading in futures and options markets for Forex requires least capital among all the asset markets. Thus, if the directional movement of the currency pair is predicted correctly, or the future volatility level is predicted then correctly, then a very high profit in percentage terms could be earned. Now let's examine the various economic events and the central bank actions affecting the INR rate. Now, what are the factors which generally causes an increase in the rupee exchange rate? Increase in policy interest rate by RBI as it increases most sections of the yield curve, leading to higher foreign fund inflows into the local bonds market. Increase in foreign direct investment oblique foreign portfolio investment, or decrease in trade or current account deficit, thus increasing the foreign exchange availability. Selling bonds in the open market operations by RBI, increase in liquidity ratios like CRR, SLR, etc., sucking out rupee liquidity from the system. Reduction in budget deficit or fiscal deficit by the government, thus reducing the expected inflation and the lower money supply growth and causing lower money supply growth in the economy. Now, what are the factors which cause decrease in the rupee exchange rate? Reduction in policy rate by RBI as it generally reduces the yield on most sections of the yield curve, leading to lower inflow of foreign funds into the local bonds. Decrease in foreign direct investment or foreign portfolio investment, or increase in trade or current account deficit, thus reducing the Forex availability. Buying bonds in the open market by the RBI, thus injecting rupee liquidity in the system or decreasing the liquidity ratios of the banks. Increase in budget deficit or fiscal deficit by the government, thus increasing the expected inflation and causing higher money supply growth in the economy. The above list is illustrative and not exhaustive. Moreover, RBI indulges in direct buying oblique selling of foreign currency from Indian markets to maintain the target currency rates. Now let's examine how directional trade in USD-INR could be done and some broad strategies to be adopted. As gap between the policy rates in India and US have shrunk to around 1 to 2%, so the forward premium and the annualized negative carry cost revolves around 1 to 2%. Generally, currency pairs have low volatility, so long USD-INR trade needs to be pursued over the long period. However, sometimes USD-INR experiences a sharp up move based on some expected economic news like USD rate hike or some economic news like crude price hike. An appropriate momentum strategy could work well during those circumstances. As RBI targets to keep the exchange rate within a band, so mean reversion strategy could work well after a sharp directional move in any direction. As the options trade at a low implied volatility of 5 to 6%, so directional trade could also be done through stock replacement strategy in options. Like long USD-INR could be achieved through long deep in money call options. Long in money call options greatly increases the leverage as only premium needs to be paid, and premium paid is the maximum potential loss suitable during period of low option premium. Generally, USD-INR does not suffer sharp fall as RBI targets a flow rate of USD-INR through open market operations. So shorting of USD-INR through futures is generally not recommended. This mean reverting trading strategy could also be adopted on sharp fall in USD-INR. The same principles of trade could be adopted in Euro-INR and GBP-INR. It is said that volatility trading is much easier to do, as volatility generally mean reverts, whereas it is hard to predict the direction of a financial asset. So let's examine volatility trading in USD-INR through options during the low implied volatility period. As volatility of financial assets moves in clusters and is mean reverting, the USD-INR gets into a period of low realized volatility, say 2 to 3% annualized standard deviation for medium periods of say 1 month. The implied volatility of at the money options is around 4 to 5% during those times. Now let's examine the broad option trading strategies during period of low realized volatility of currency pairs. Long straddle, that is buy at the money call and put options with the same strike price. Short straddle or short strangle with full hedging by out of money long call and put options. Short straddle means shorting call and put option with the same strike price, and short strangle means shorting call and put options with different strike prices. Now what happens if price remains around same on the expiry? The extrinsic value of in the first strategy, the extrinsic value of the premium paid is lost. In the second strategy, as short premium is more than the long premium, the position ends in gain. Now what happens if there is a major change in price on expiry? In the first strategy, as intrinsic value of the profitable options is more than that of the unprofitable option, so the position ends in gain. The position remains profitable in a range. In case of second strategy, the position remains profitable in a range but turns unprofitable if the price moves beyond the range. If price moves beyond the range, the adjustment needs to be done to the position, like booking profit in the option leg which has turned profitable and taking new positions in that leg. Now if implied volatility of option increases, that is premium rises during tenure of the contracts, the long straddle turns profitable, so better to book profit in that. However, the short straddle turns into loss, so better to wait till expiry. Now let's examine how to do volatility trading in USD-INR through options during high implied volatility period. The USD-INR gets into periods of high volatility. Consequently, the implied volatility of ATM options surges to 6 to 7%, thus creating a conducive environment for net short volatility strategy. As volatility is mean reverting, so realized volatility and premiums generally fall after a period, thus giving good profit on the position. During such periods, it is better to short options for longest periods traded in the market, as that will lock in high premiums over long periods. The implied volatility curve generally follows high kurtosis around the tails. So the strike prices of the options chosen for shorting should be a bit wider. Here two different trading strategies are explained, but actual choice depends on the risk appetite of the traders. Both the positions mentioned below remain profitable over a range and the maximum loss is predetermined. The profit range and the maximum loss depend on strike prices of the options chosen. A high implied volatility of the options. One strategy is the short straddle, that is short at the money call and put options, and hedge the same by long out of money call and put options. The strike prices for long options depends on the risk appetite of the traders. As low risk appetite means a narrower range for the long options, whereas a higher risk appetite means a higher range of the long options. This is a defined risk strategy with maximum loss increasing with increase in the range of the long options. Now let's examine the second strategy, which is the short strangle, that is short out of money call and put option and long out of money put and call options, but the position could have net short options. That is, the strike prices of the long options chosen are wider than the short options. Now, higher risk appetite means narrower strike price range for the short options. The higher risk appetite strategy means narrower strike price range for long options and higher gap between the number of short and long options. This is a defined risk strategy, so the possible maximum loss and profitable range is determined beforehand. Now, if the price remains around the same, then short straddle is more profitable than the short strangle. A sharp price movement in any one direction could take the price beyond the profitable range, and the position needs adjustment. Now let's take an example of the short straddle. Suppose the spot price is 83.5, short call and put options strike at 83.5 since we are shorting at the money options, long call option at 83.75 and long put option at 83.25, that is longing with that is hedging with long out of money options. High in range profit, this position has a high in range profit but narrow profitable range. Thus, the example of short strangle is, suppose the spot price is 83.5, the short call option at 83.75 and short put at 83.25 strike. That is two out of money options, and long call at 84 and long put at 83. Lower in range profit but wider profitable range compared to the first strategy. Now let's examine the broad conclusions of this whole presentation. The option pricing of currencies considers the future price on expiry date as the spot price. So as all four currency pairs have a contango shape for future price, the spot price considered by the market for option pricing is more than the actual spot price. Therefore, at the first look, the call options appear more expensive than the put options. As the Indian Central Bank targets a range of USD-INR exchange rates, so outlier movements are infrequent, thus making option selling with appropriate tail hedging a consistently viable strategy. Directional trading in USD-INR is also a viable strategy in anticipation of RBI action or anticipated movement in the USD index. The retail investors could trade in short-term futures of other currency pairs, but those are little more volatile due to lower liquidity. As exchange rate differential is a function of interest rate differential, so currency movements provide a broad direction on bond price movements also. So this concludes this whole presentation. Thanks for watching.